Well, welcome to Investor in the Family Radio. This is Brian Bain, your host. So excited to have you with us today. And last week, we got kind of reintroduced back into our Berkshire Hathaway Letters to Shareholders series we're going through. And we got our special guest back with us today, David Reyes. Say hey, David.
Hello, hello.
So David is with us. He is my young millennial friend.
That's right.
We found out last week he's 26 and 3/4 years of age. And he knows almost nothing about investing. And so I asked him to come on the show as kind of like a sounding board for us as we're kind of learning from Buffett, one of the greatest investors of our time. And so kind of a great way for us to kind of learn together and have some more fun in the process. So we've been walking through the letters step by step. And last week was kind of a refresher review time. And then this episode, we're diving into the 1971 letter to shareholders of Berkshire Hathaway. And again, we're using the Max Olson, the book that Max Olson put together, which basically just compiled all the letters, but it's kind of the best place to have them all in one spot. So, hey, David, man, thanks for coming back.
Yeah, it's good to be back. I'm excited about it. Excited about digging in here to the letter.
Yeah, and we had a really fun conversation in our last episode, kind of getting up to speed on kind of the background behind Berkshire Hathaway and what Warren Buffett's been doing, as well as a lot of kind of broader investing topics, which we'll continue to bring in throughout the series. But we talked about Warren Buffett bought Berkshire Hathaway in 1965. It was just a textile company. And we talked about how it really, in a lot of ways, is a model for the way he ran and continues to run Berkshire Hathaway. It's kind of a model for how I think we can run our households. Mm-hmm. So he came into, at the time, Berkshire Hathaway was like just a textile company that was struggling. And so he came in, and what he did was he didn't abandon ship. He didn't quit on the company. He tried to look in and figure, okay, how can we basically get the household in order? How can we get this business in order? Where do we need to cut costs? What operations do we have that aren't performing? What is going well that we can invest more money into? And so again, I think about our own households as kind of a mirror for that, and thinking about, okay, if we're not doing well financially, or we could be, or even if we are doing well, maybe we can be even more efficient. And kind of the equivalent of that for us is looking at, okay, what expenses do we need to cut out? What expenses do we need to reduce? What are good investments that we're making, not financially, but regarding our family that we need to continue? And so that's one basic thing to think about. But the main thing I want to focus on right here, or just bring into play, because it's going to come into account in every one of these letters, is what we start seeing fairly early on is Buffett starts investing any extra money they have outside of Berkshire Hathaway or the textile company, which is really unique because most people, if you have a business and that business makes money, you either pull that money out and keep it yourself, or you reinvest it back into that business. If that makes sense, right?
Yeah.
But what Buffett did was he realized, okay, we now have extra money. We'll say extra capital. Those two can be interchangeable for our conversation. So I have extra capital. Then he says, okay, where will this capital be treated best? And right now, putting that capital, that money back into the textile company does not look like it's going to give very good returns, so I'm not going to do it. And so they started reaching out to looking outside of the textile industry to figure out where can we invest this money externally to get the best return possible. And that sounds so simple and basic, but I love that mindset of he is actively looking for the best possible place to put his capital to bring the best return at the lowest risk.
Yeah, and I think it's really, I feel like still kind of coming in fresh, that is something, like you mentioned, it is something unique, because I feel like I instantly don't think about that. Don't think about, hey, let's see what else is out there, what other options, because I guess I could be so single track focused sometimes where I wouldn't even think about going outside of that.
Well, and if we're honest, most of us, if we have extra money, we spend it.
Yeah, exactly. So it's like, hey, that's just a little bonus for me.
Well, and one of the things I like to say a lot too is that every dollar and minute we spend is an investment in something. And there are tons of investments out there that bring no financial return that are worth it. You go take your wife out to dinner, a great dinner, and you have a really great time investing in your marriage. That was probably a good use of the money. You're not getting financial return out of that, but it was a good use of your money, So it's
right.
helpful to remember that, and because we can't get in the mode of, extreme capital efficiency where, we only want to put money where it's going to return more money. And, that's not a really healthy way to live life either.
Right.
But I just kind of give that background. We won't revisit all the things he did in those previous letters, but you notice he started buying insurance companies. He started buying banks. He bought a newspaper. He started new companies, mostly insurance companies, because he found that those ventures were bringing a healthy return on his investment that he could not get if he put that money back into the textile company. And that's really where you started getting the beginning or the genesis of what Berkshire Hathaway is today, because now, again, they own 50 to 60 different companies or something like that. But that's how it started. And it's kind of fun to see how it started small and how disciplined they were with allocating their capital. Like most people, we think about investing, we think about buying stocks. And, if you've been investing for any period of time, you'll think, well, you've heard the advice from people like Buffett. Hey, whenever you buy a stock, you should be thinking about, okay, you should take it as seriously as though you're buying the entire company. And you should be ready to hold on to it for a really long time. And so if we were going to buy an entire company, you're going to take that really seriously and look really deeply into the financial statements and the management until you can feel confident that this is a good decision. But, if we're putting a couple $100 or a couple $1,000 into a stock, it's not near the same scale, so we don't take it as seriously. And with online brokers, we can jump in and out in a few minutes. And so we don't take it as seriously as we should. But I love with Warren Buffett, who took a relatively small investment and turned into hundreds of billions of dollars, they may only make a few investments in a year or every few years, which is just totally radically different than most investors that I know, and another great, kind of discipline point to focus on.
Yeah, that is true.
So, okay, so that is some backdrop coming back into the 1971 letter. And so here we are in the 71 letter, and I'm going to totally not we'll kind of put you on the spot, but you can back out. Anything from when you read this letter stand out to you to think, hey, that was interesting, or I don't understand this?
I think I kind of understand kind of where he was going, just with talking about kind of you were saying the insurance businesses and the banking business, and kind of breaking down each of those investments and kind of how it is. But I always love how he really starts each letter and just kind of reporting the capital gains, reporting all that stuff, but also even in some of the operations itself, the textile operations, he said they continued to struggle throughout 1971 with inadequate gross margins, things like that. I love the ebb and flow of the letter, because it's sharing, hey, here's this thing that we continued struggling with. And even in some of the other letters I've read, it's like, hey, this is kind of what was forecasted, and unfortunately this happened, and it's just kind of things like that I see as a letter to a shareholder. I'm like, wow, that's pretty vulnerable stuff, and but it's just honest, it seems like. Right.
Well, and like I said, he starts out each letter, it's very honest, and as we get into future years on future episodes, some of them are like brutally honest. Like he's like, this was like horrendous. I think actually one of the letters he actually uses the word horrendous. I won't get ahead of the game too much, but he starts out each letter with a little kind of a synopsis, and then he goes, usually in most cases, a kind of like sector by sector with like textile, banking operations, insurance operations, and stuff like that. But he mentions, it was a pleasure to report that operating earnings in 1971, excluding capital gains, amounted to more than 14%. This result is considerably above the average of American industry. Oh, yeah, and then he says this was achieved in the face of
inadequate earnings.
Yeah, no, but I was looking at my note. I'm reading from the letter, then I'm looking at my notes too, because I'll make sure I'm not stealing thunder from later in the episode, but I think I'm not. But he says, was achieved in the face of inadequate earnings in our textile operation, making clear the benefits of redeployment of capital inaugurated 5 years ago. And he's basically reflecting on that decision I mentioned a while ago of 5 years ago, they made the decision, our money will be treated better, invested somewhere else. And he's saying, our core business did really bad, but we still made 14% return on our equity this year, which is awesome. We mentioned earlier, like given that framework, or this is the last episode, with 14.484% returns annually, someone could turn $12,000 and add 5,000 a year, and in 20 years you could retire with a $100,000 a year ATM machine going, which sounds insane, but that's the power of even just 14.84%. And that 1 year they had 14%, so it gives you a little bit of perspective there. But then he jumps into textile operations and continues to talk about how they struggled throughout the year. But one big thing that I love in the textile component is, again, he mentions this man named Ken, I guess, Chase. It's C-H-A-C-E. I'm going to call it Chase. And he says, as mentioned last year, Ken Chase and his management group have been swimming against a strong industry tide, on and on. But then he goes, but he goes on just to praise them. And he praises this manager of this business. And throughout the letter, as he mentions every time he mentions a different segment of the company, he's very intentional to mention who's leading that segment, and he praises them heavily. And I love that.
Yeah, that is, well, and that's like to think about, being in a letter and being, I guess, just the organization communication standpoint of it. That's powerful, because I really feel like that's empowering. I would think for those individuals.
Well, and also exactly. And the thing is, with like what we see is like Buffett relies heavily on these managers. He's not running the textile company. He's not running the insurance company. He's not running the banking company or the newspaper, any of those things. He's not running them. Like, their success is contingent upon having fantastic managers leading those companies. And I think a lesson for that, first of all, for us is realizing if we're going to manage our own investments, especially as DIY investors, like we're not professional investors in most cases for our listeners, it is, I'm going to try to be gentle, it is naive at best. I mean, and except there may be some rare exceptions, but generally speaking, it is very naive, even foolish, for us to think that we can manage all of our investments actively by ourselves on a part-time basis without help. Yeah. Without help, my point being, without help.
Right.
And that help may be a financial advisor. It may be paying for online research through a newsletter or something else, or some kind of training. But without some kind of outside help, the idea of really being able to have success and invest successfully over a lifetime is naive, if not even just foolish.
And I think it just shows how much trust he had in those individuals,
right?
And how much he wanted those shareholders to see that trust and to get them to understand that, hey, these are individuals whom I trust and whom we all can trust in this regard.
Well, like you said, it's empowering. If I'm one of these managers and, I'm going to read this letter once a year and realize, man, the dude who I report to, like, he is in front of, is for all the anyone who wants to read it to see, all the shareholders and anyone publicly who wants to see this, he's saying, I'm doing an amazing job and he believes in me, even though the company is struggling. And that's a situation where, like, okay, I know that my boss has my back. Right. And when that's true, like you said, you're so empowered to do what the job needs to be done, even if that means some painful short-term losses or decisions for the sake of really successful long-term success over the long-term ongoing. And one thing with that too that you may not be very familiar with, but a lot of our listeners probably are, is that one of the ways things work as DIY investors, maybe you have an advisor you use, or maybe you don't. But kind of the way the online investing world usually works is people sell newsletters. So you have an investor who maybe they're really successful, or maybe they're good at sounding successful, one of the two, or somewhere in between. They'll have a newsletter, and they usually sell a monthly or an annual membership or lifetime membership to that newsletter. And basically what they do is you're paying for their research. And they're doing all this research on their own, sharing the research, and then sharing suggestions or recommendations on what stocks to buy in light of the research that they've done. And so you pay them because typically you think, okay, this person's really good at investing, so I'm going to pay them to kind of as a shortcut. So instead of me having to do all the training, spend all the time, and spend all the energy trying to find great investments, I'm going to pay someone to share them with me, and then I can read the reports and decide whether or not I want to follow them or not. That's kind of a common way that investing works, or the industry
that makes
works.
Sense.
Yeah. And so that's where I feel like this is so helpful, because I realize, in my opinion, to do this well over a lifetime, you're going to need help, and you're going to need good managers. And when I pay for a newsletter, that's me hiring a manager. And so in the same way Buffett is relying on these different people to run his business, I'm relying on other investors to help run my investing business for me. I'm still responsible. I'm still in charge. I'm still making the final decisions, but I'm hiring this person over here to help guide at least a portion of my portfolio.
Right. I even see here on under the insurance operations, he talks about the company that was built by Victor Robb, I believe is his name. But he even says, while Vic has multiplied the original equity of home and auto many times since its founding, his ideas and talents have always been circumscribed by his capital base. And I just even love him mentioning the ideas and the talents that he has, knowing that he's not in this alone. He has people that are going forth and providing new ideas, providing new ventures. And I think that's a sign of a healthy, great team.
Absolutely. And thinking about it like a team, and again, like in trying to, want to pull as much out of these letters as we can that can be immediately applicable to us as DIY investors, again, is when we're looking at who we're going to hire as managers, man, being really careful who we hire, and taking it very seriously. And the thing is, once Buffett bought a business, so it basically he hires people by buying their companies from them, essentially. Yeah. But once he bought them, but he would not make these purchases of these companies unless he had incredible confidence in that manager. And in the same way as if we're looking to subscribe to a newsletter or hire an advisor or whatever outside of management we want to use, we need to be super diligent to troubleshoot that in advance and filter that in advance to figure out, okay, is this advisor, do they align with my goals? Do they align with the philosophy of investing that I believe in? How am I going to be charged? What are the fees? All that type of stuff. There's all kinds of, you can Google questions to ask your advisor when filter them and stuff. But also with an online newsletter, figuring out, okay, is this someone like that I want to hand management over to my portfolio to, or at least a portion of it. And then once you make that decision to commit to it, I really feel like it's wise to then just trust them. Because one of the problems we get into is you pay someone for a newsletter and then you kind of jump in and out of what they say. You don't really follow them super closely. You try to then make your own decisions. But it's like, okay, so you're hiring a professional, and then as a non-professional, you are then filtering his decision making, which is something that I'm not saying you shouldn't do that, but you need to at least be honest about the fact that it kind of doesn't make sense.
Right. Yeah, and I think it's all about just the trust game, because I think that's something that scares me, just as someone who's just kind of coming into this not really or really unsure about some of this stuff, and like, okay, how do I know these? And we talked about it a little bit in the last time. It's just understanding, okay, who can I trust here? Who is kind of has ulterior motives, and it's kind of scary going into it. And so I think why you were saying, why would you want to pick and choose when you're putting trust in this person? So this is interesting.
Well, and you made a comment, I think offline, we weren't quite recording yet a few minutes ago, about even in your situation, you've got people who are reaching out to you and say, hey, let's go grab lunch, and that they're like in the investing space, and you kind of realize, okay, you haven't talked to me in X number of years, so there's probably a reason for this, and how realizing that there's ulterior motives there can make it, again, it affects that trust component.
Yeah, it's hard to enter in, and kind of we talked about at the beginning of the episode is, you see people kind of your age, or you see people kind of in your framework, and they're trying to figure out, or you see them and you're like, wow, they're really successful, or they're really doing something big, and you're just kind of wondering, okay, are they someone I want on my team? Are they someone I want? And I think it just takes us doing the research. It takes me kind of going out and finding this, and I think this is why what you're doing here with Investor in the Family is such a great tool, because it really just allows you to enter into a conversation where you can prepare yourself for that, and you can understand what the research you need to do should be.
Right. Well, and also one of the challenges too is, like I said, but ultimately filtering down, like who of these people, how do you find out who to trust? And that's one of the challenges even I have with my business is, I like to think that I've got good motivations and I'm trying to help people, but I'm still in the middle of an industry that in most cases has kind of a negative reputation of taking advantage of people. And so one of the reasons I picked the name Investor in the Family for this business is, I know tons of people who don't have investing backgrounds but want to learn about investing, kind of like yourself, and would love to have an investor in the family they could turn to, kind of like that, that uncle at Thanksgiving. You go to, it's like, hey, my elbow is hurting and I don't really want to, do I need to go to the doctor, or can you tell me what to do? And it's just easier to talk to him because you trust him.
Yeah.
I want this business to kind of serve that purpose. That's why I named it the name that I did. And it kind of has a dual purpose. Also, most people I talk to are also the investor in their family, so it kind of goes both ways. But one of the challenges too is picking out a good newsletter. Is like, how do you know which one's good in advance? And that's why I'm a big proponent of transparency. And obviously, a newsletter, isn't going to be able to usually share existing investments, because then why would you pay them if they're giving it away for free? But what kind of track record do they have, and what have they done in the past, and what philosophies are guiding their investing, and do they align with yours, and do they have some kind of a track record to validate that? I think are really important components.
Yeah, and accountability. How am I going to keep that person accountable, or how are they accountable to me in some way? Because I think a lot of times what I'm always nervous about is if I'm just finding out, if I'm entering in, I feel like I would be entering in, okay, I got to be accountable to them. I got to be doing my part. But in reality, the trust comes from, they're coming in, and the people that are working with you and partnering, these managers, they're people that are holding themselves accountable to you. And so that it always helps. But for me, for some reason, I always feel like I need to go into it saying, okay, what am I going to offer? Totally. It would be really easy for Warren Buffett to go into these things and say, okay, this is what I'm going to do. And hopefully it aligns and things like that. But no, it's like they have to be held accountable, and their ideas and their visions can be good. But they got to make sure they're, I guess, just holding themselves accountable to you.
Yeah, because ultimately they work for you, technically.
Right.
And again,
that's what's always weird. Is like, how do I, that finding that balance of like, oh, they're working for me, not against me, but how am I ensuring that?
Well, and I always tell people too that there's a spectrum in this stuff as well. Like even if whether you want to fully manage all of your own investments yourself, or if you want to fully outsource all of your investments, like, you need to be educated. Because the better you understand investing in finances, the better you'll either be able to manage them yourself, or the better you'll be able to hire someone else to manage them for you. I think one of the reasons why you get in a situation like you described, like you feel like you've got to and be accountable to your advisor, for example, is usually because there's a big power gap there from knowledge. Like, they know we presume they know what they're doing, and you feel like you don't know what you're doing, therefore you feel inferior. But one of the things we want to change is to kind of erase that power gap. So at a minimum, you know enough about investing to be able to talk the talk and be able to hold them accountable, instead of just thinking, well, I don't know what's going on. Kind of like your car mechanic. You can go, if you don't know much about your car, you take it in someone, they're working on your car, and they say, oh, well, you need this work done and that work done, and you're kind of like, I guess I don't know enough to say if you're right or not.
Yeah, well, I guess I need blinker fluid. I didn't realize that was low, but it's like, it's low. I mean, I think that's a perfect example for me to understand it, because it's like, it's sometimes scary to go there too, because you're just unsure. And I've just realized sometimes the fear lives in the lack of discipline to educate ourselves.
Well, and also, and making it more intimidating than it needs to be. Like, it doesn't have learning enough about investing to make good decisions like this. Like Buffett said, it's not as big of a deal as people naturally think. And we can make it super complicated, and finding great investments can take a lot of hard work and stuff. But generally knowing enough to manage this stuff is not as complicated as people naturally think. And just like with car, I mean, you can learn enough about a car to know whether or not your blinker fluid needs to be changed or not. You know what I mean? And so I think that's helpful to reduce that power gap, and then realize, okay, they need to be accountable to you. And granted, they can fire a client as well, but generally speaking, you're responsible for the wealth you are working at least 8 hours a day, 5 days a week, every day. Every week of your life to make money, and then you just hand the money over to someone blindly. Like, how foolish is that?
Yeah, exactly.
So regardless of how active or passive someone wants to be with their investing, it's naive to not learn more as an investor and become more educated. But okay, there's a couple of things I want to make sure and jump into in this letter that to not miss before we wrap up here in a few minutes. There's a couple things from the 71 letter that I found really interesting. First of all, there's this, when he gets into his insurance operations, and again, people who are more Buffett familiar, this may be old news, but for a lot of us it's not, is the fact that you think, well, why did Warren Buffett like insurance companies so much? Like why is that a great investment, And here's the thing. One of the things that helped Warren Buffett and his company, and again, in future years, we'll see that in the 71, those insurance companies were doing going like gangbusters. Like they were doing fantastic. They're bringing in tons of capital. But the thing about it that was so significant is, let's see if I have it underlined, is that, I don't know if I have it underlined in front of me right now, but basically what he was doing was he used the insurance companies to bring in capital that he can then invest somewhere else. Because you think about the way insurance company works is premiums come in, but as long as your operating expenses are low and there's no significant like big event or payouts, then you just brought in tons of capital, right?
Right.
And so, or maybe you have a lot of money sitting aside and is like a kind of a pool of money to in case something big happens, you need to pay out for your insurance premiums. But basically, he's able to pull in tons of money that he could then use to invest elsewhere, like in bonds or in stocks, to make money off that money. And so basically, it created this huge influx of money to then invest and make more money off that. So he's making money off the insurance company, and then he's making money off the money the insurance company is making, if that makes sense. It's like a double investment. And we'll see in coming years that becomes a bigger and bigger component of the business. I thought that was fascinating, and that may be fascinating to you, but it's just helpful to realize, what a brilliant, like, I don't know if people were doing that before him or not. Maybe they were, but that's brilliant.
No, and I think it's helpful to understand why he picked that, because that was a question that I had, is like, why insurance?
Yeah. It's not, again, how boring is that, right?
Doesn't Warren Buffett own Dairy Queen?
Yeah, I think, like, I forget. Let me look back.
I think I saw that somewhere one time when I went to a Dairy Queen, and I was like, random, but okay, cool. Right. Like, I just was like, didn't think when I was eating a dilly bar or whatever they have at Dairy Queen.
Blizzards, man. They're called Blizzards, dude.
Blizzards, yeah. It's interesting. Blizzard. But I just was like, wow, Warren Buffett, okay.
I'm looking back at the companies they've acquired. It must have been a subsidiary of a different company, because I'm not seeing it on here. But I'm pretty sure that's the case. I know he's got strong ties to Dairy Queen, either as like
maybe he's just a big fan.
He's a big fan. I mean, who doesn't love a Blizzard? You know what I mean?
Yeah, exactly.
So yeah,
but it is interesting just how how you choose what you're working with is a helpful thing too.
Well, and how he starts diversifying. Like, again, you got a newspaper, you got banks, you got insurance companies, and so on. Of course, insurance companies and banks are there's both in the financial sector, but still. Okay, and there's one other thing before we wrap up here in a few minutes. I wanted to just, as I was reading through this letter, that just kind of jumped out to mind, something to think about. Again, as we're investors building our own investment businesses and thinking about how we want to manage and structure things. Because Buffett's got all these different companies he's acquiring and he's running. And I thought, what about the idea of, I wrote it down here. So what about the idea of setting up various portfolios as business centers? Sounds very like clumsy language. But basically, the idea of, Buffett was becoming an investment conglomerate and he's buying other companies, right? So for us, we think, well, I can't buy a company outright, but I can buy stock in a company and I can view it the same way. And so think, okay, well, what if I, on a small scale, you could view it as, well, this year I want to buy an insurance company. So you go and buy, a certain number of stocks of, name an insurance company. Okay, so that's kind of be your way of kind of following Buffett's footprints.
Yeah.
But I wonder also, like, what about, like, actually, like, starting certain portfolios? Like, for example, I want a portfolio that is focused on a certain style of investing. Maybe it's, more aggressive. Maybe it's investing in insurance companies, or maybe another portfolio to focus on investing in bonds type stuff. And again, those could all be parts of one portfolio, and you can look at a lot of different ways. But I just thought it would be interesting, because one of the things that I run into is, sometimes you see too many great opportunities, and you need to really work hard to filter those down. But if I want to get into investing or insurance companies, maybe I, set up a portfolio specifically dedicated to insurance companies, and I kind of build a certain fund made of insurance companies, if that makes sense. And it's not a radical idea, but it's kind of an intriguing idea that I thought about. So that could be a kind of my way of starting my own business investing conglomerate, is by starting different portfolios with different focus instead of buying a bunch of different companies outright, which I'm not ready to do yet.
That kind of brings to mind, like, starting out as an investor, someone who even just wants to start on that, would you consider casting the net wide or pretty tight with kind of new investment opportunities? You mentioned kind of sometimes hard to say no to some things or look at some things and be like, no, that's not an issue. So would you suggest kind of diversifying pretty aggressively at first, or kind of starting pretty narrowly?
Well, I mean, the kind of the generic thing I always say is that, first of all, not giving any specific investment advice, just generically speaking. If I was starting out brand new as an investor, didn't have much background, I think it's wise to, first of all, be slow and patient. And, there are a lot of funds out there that allow you to invest like in the entire stock. They're called ETFs, that we can invest in the entire stock market. You can buy one share of this company, this one share of this fund, but it's kind of like you're super diversified over a lot of companies. So the success or failure of any one company doesn't impact you too much. And those are considered much safer investments. Of course, if there's a big stock market crash, you still lose money like anyone else would.
Right.
And there are other risks to those type of investments that we won't get into right now. But yeah, because I think you don't want to invest in something that you don't understand. And so if you don't understand an individual investment, in my opinion, it's not wise to make it until you do. So by default, it makes sense to, own kind of either just keep your money in cash initially until you find investments that you feel confident in, or you could put your money into some funds that are fairly conservative, so you maybe can make a little bit of money while you're learning in the meantime. And then maybe once you find an investment that you've really researched, you feel you feel good conviction about, because excitement can go away and can be misplaced, but you feel good conviction about for good sound reasons, then maybe you take a small percentage of your portfolio, like 2%, and put it in that company, and you build from there,
Right.
I think that's a wise way to start. Another thing someone could do is, once this can take time as well, really become confident in like a manager that you've hired or could hire, like another investor you can pay for the newsletter or whatever else. And you could say, okay, this person has their investing goals and strategy align with what I want mine to be, and they have a proven track record. So then I'm going to just kind of put an X percentage of my portfolio, quote unquote, under their management. Like basically you're taking 10, 20, 40% of your portfolio, and you're just going to take that portion of your portfolio and mirror what that person is doing with their entire portfolio, if that makes sense. So there's a number of ways you can do it, but the number one rule that I would say is never make an investment that you don't fully understand. And so until you do, be conservative and generic probably.
Yeah, I think it is interesting just kind of looking at, what Warren Buffett did. Now, we talked about that a little earlier, and you kind of think like, well, this is kind of interesting. This is kind of random, but I think it all just takes this really a good knowledge of what you're entering into. And it may seem random or, really diverse and maybe too diverse, but as long as you have that good understanding, I think that's super helpful.
Right. And again, and a lot of the things that he does may not correlate obviously directly to us. And even the idea I mentioned about having different various portfolios, there's some things about that I think, may not make sense and may not work out, but it's helpful for me I love brainstorming and thinking of different ways of doing stuff, because, there's so much out there saying, hey, it's impossible to beat the markets. Hey, and I put information out there too, because I want people, not because I want to scare people, but I want people to be sober. Like, most DIY investors don't do well. Most DIY investors would do better just putting the money in a generic stock market fund and letting just make money like the general market would. But right. I'm a firm believer in what Buffett said. If you have a sound plan and the discipline to stick to that plan, I believe beating the market is possible. And I believe that even beating the market in a significant way is very possible. Like, I refuse to believe it can't be done by DIY investors, even though I know that most don't do it. But I believe the reason most don't do it is because they don't have a plan, and then if those who do don't stick to it. It's like budgeting.
Right.
How many people actually have a budget? Not many at all. And then of those who do have a budget, how many actually stick to it? I bet very few. And so we think, well, it's hard to manage a household. It's hard to stay out of debt and all kind of stuff. So, well, but if you actually have a plan and stick to it, it's very reasonable. And so I think the same thing with investing, but almost no one does it. And so one of our goals here is to be those people who do it. So
yeah, that's helpful.
Yeah. So okay, with that being said, I'm going to wrap it up with this quote right here from Buffett toward the end of the letter. He says, "We retain a fundamental belief in operating from a very strong finance position. We will continue to map our financial future for maximum financial strength." The reason I say that is he continues to be committed to maintaining a healthy financial household, or in this case, it's business, but for us, and the importance of us being really committed to managing our household well and taking it seriously, because our household is our number one generator of investment capital. So the more income you bring in, the more money you have to then invest. Or the better you manage your expenses, the more money you have left over to invest later on. And those investments can lead to other investments and other investments if you do them wisely. So takeaway from that is just like Buffett, being super committed to managing our households well and being ready. So when great opportunities do arise, we're ready to strike when they do come. So thanks everyone for listening, and we'll talk to you next time. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.